You know, when it comes to money, we all like to think we're totally in control, right? That we're making these logical, calculated decisions. But what if our own minds are actually playing tricks on us? Well, today, we're going to dive deep into the fascinating world of investor psychology and find out why we're not nearly as rational as we think we are.
So let me ask you a question, right off the bat. Are you a perfectly rational investor? Do you weigh every single piece of information, act only in your own self-interest, and never, ever make a mistake? And I mean, be honest with yourself. Because if you paused for even a second, you are in very, very good company.
Okay, so let's start by digging into where this whole idea of the perfect investor even comes from. It's actually a really core concept in traditional economics, but as we're about to find out, it might just be, well, a myth.
This whole idea is called the rational actor theory. And it kind of paints this picture of us as these flawless financial robots. The theory assumes we have all the information we could ever need, we process it perfectly, and we always, and I mean always, act to get the best possible outcome for ourselves. This is the perfect investor of classical finance theory.
It's a really nice theory, right? It's clean, it's simple, it's logical. Yeah, there's just one tiny problem. It doesn't really match what happens in the real world. So let's get a reality check and see how real people and real investors actually do.
Well, it turns out study after study shows the exact same kind of shocking result. The average investor doesn't just fail to beat the market, they consistently don't even manage to match it. There's this huge, stubborn gap between what the market is offering and what investors actually end up with in their pockets.
And check this out, this data from a 2015 study is just absolutely eye-opening. While the S&P 500 index returned nearly 14%, the average investor in stocks, they saw a return of just 5.5%. I mean, wow, that is less than half of what the market returned.
Let's boil that down to just one number, shall we? That's an underperformance of 8.19% in just 1 year. This number right here brilliantly illustrates that massive disconnect between the theory of the rational actor and the reality of the everyday investor.
So, that leads to the big question, right? If we're all supposed to be these logical, calculating decision makers, why does this gap exist? What in the world is going on in our heads? This is exactly what this super fascinating field of behavioral finance tries to answer.
All right, so let's peek inside the investor's mind. It turns out it's like our brains come with this pre-installed software, you could say. Psychologists call them cognitive biases, and they can really lead us astray when we're making decisions about money. Let's meet a few of the usual suspects. First up is a big one, loss aversion. It's based on this idea called prospect theory, and the concept is really simple. Basically, the pain of losing, let's say $1,000, feels way, way worse than the joy of gaining $1,000. Our brains are just hardwired to avoid pain, and that has huge effects on how we invest.
Yeah, this quote just nails it. A loss always appears larger than a gain of equal size. I mean, just think about it from a financial advisor's point of view. A client whose portfolio is down $50,000 is going to be way more upset and way more likely to call than a client whose portfolio is up by the same amount. The emotional weight just isn't the same.
So what does this actually do to us in the real world? Well, it makes us do some pretty irrational stuff. Just to avoid the pain of making a loss real by selling, we will hold on to our losing investments for way too long, just hoping and praying they'll recover. We actually end up taking on more risk, all to avoid that terrible feeling of being wrong.
All right, next up, we've got something called mental accounting. This is that weird thing our brain does where we treat money differently depending on where it came from or where we've decided it belongs, even though, a dollar is a dollar. Okay, this classic example explains it perfectly. Scenario 1. You lose a $20 bill out of your wallet. When asked if you'd still buy a $20 ticket to a show, 88% of people say, yeah, of course. Scenario 2. You've already bought the ticket, but you lose it. Now only 40% of people would buy another one. But hold on a second. In both scenarios, you're out $40. The outcome is identical, but because we put that lost ticket in our mental entertainment bucket, buying another one feels like the cost has suddenly doubled.
And of course, we got to talk about good old overconfidence. It's just human nature, isn't it? Most of us think we're above average drivers, and it's the exact same thing in investing. We tend to think we're better than average at picking stocks, or that we can perfectly time the market's ups and downs.
So what's the damage? Well, all this overconfidence usually leads to one thing: trading way too much. We're constantly buying and selling, trying to outsmart everybody else. And all that activity just racks up fees and transaction costs that slowly but surely start eating away at our long-term returns. So as you can probably guess, all these ideas about our behavior have sparked a huge debate in the financial world. Look, this isn't exactly settled science. It's really a big debate between two major schools of thought.
On one side of the ring, you've got behavioral finance, which is what we've been talking about. It argues that, hey, investors are often irrational, and that creates inefficient markets. But on the other side, you have the classic efficient market hypothesis. This one holds that, no, investors are rational, at least as a group, that market prices reflect all the available information, and any weird blips we see are just short-term noise that gets corrected really quickly.
But check out this fantastic quote from the financial historian Peter Bernstein that really puts things into perspective. What he's basically saying is, okay, sure, we get it. People act irrationally. But can you actually use that information to consistently make money? It's a great point. It highlights just how hard it is to turn these fascinating insights into a profitable, repeatable strategy.
Okay, so you've got this big debate raging on. What does that mean for you, the investor? What's the practical thing you can actually do with all this? Let's try to boil it all down.
At the end of the day, the biggest takeaway is probably this. A lot of the time, the biggest obstacle to our own success isn't a crazy market or a bad economy. It's the person staring back at us in the mirror. Our own biases make us buy high when we're greedy and sell low when we're scared. We end up sabotaging our own financial goals.
So what's the solution? Well, the answer is surprisingly simple, but that doesn't mean it's easy. Step 1. Create a solid, logical investment strategy before emotions get involved, one that's based on your actual goals and your comfort with risk. And step 2, and this is the really hard part, you have to stick with it, especially when every fiber of your being is screaming at you to do the opposite.
And that really brings us to the final and maybe the most important question of all. Just knowing that these biases exist is a huge first step. It really is. But the real test, the real challenge, is whether you can spot them in yourself in the heat of the moment, when the market is tanking or soaring. Can you master your own psychology when it truly matters most?